Howdy, Jacob here. Today we're looking at Carlisle Companies Incorporated in the industrial conglomerates industry, 18.8 billion market cap, essentially the same enterprise value. Founded in 1917, they operate as a manufacturer and supplier of building envelope products and solutions globally. Their growth has been relatively small as expected over a 10-year period for a company that's been around for over 100 years. 3.2 billion in revenue in 2014 to 4.6 billion in 2023. Their operating margin is up a lot, and their gross margin is up to almost 10%, about 10%. So pretty positive signs on the margin perspective. Their dividend has gone up, but also earnings per share have gone up plenty as well. So their payout is very reasonable. Pretty good return on invested capital, appears to be averaging in the double digits, which is very likely above the weighted average cost of capital. Very positive sign. 577 million cash on hand, 403 short-term debt, 1.9 billion long-term debt. So they do have a little bit of debt here. That, let's say 2 billion, round up a tad, $2 billion of debt of long-term debt in relation to their free cash flow figure recently at $1 billion is just 2 years. It's averaged a little bit lower. So if they're able to sustain these high levels of free cash flow, given they did make a large 1.6 billion net acquisition in 2021, and it does appear that it helped their free cash flow quite significantly. So if that's truly from that acquisition, then we think that they might be able to sustain at least $800 million in free cash flow. Then we're not concerned about that debt figure. Since they have enough cash to write off short-term debt and long-term debt is less than 2 years or roughly 2 years of free cash flow, not concerned with that. And they have been reducing their debt somewhat considerably since they increased debt for this large net acquisition here. Their use of cash otherwise, outside of that one-time acquisition, that one large acquisition, they've made some more small acquisitions, mostly a substantial amount of share repurchases with a little bit of a dividend, 1% yield, and it's less than 20% of their free cash flow. So I think we're ready to start making some assumptions here. The revenue growth side, I don't think we're going to be seeing immense growth here. I'd see maybe 4%, saying that they have somewhat considerable growth to inflation, and then maybe a little bit greater through a slight amount of allocation going towards acquisitions and reinvestment. Margins, I love that recently the margins are greater, so maybe I'll be able to do, this might be too much, but let's try 15 and 16%. For share change, they do buy back a lot of shares, 1% for them, round up about 200 million. 200 million of share repurchases, 400 million would be about 40% of capital allocation. I think I feel comfortable with that. P for a company like this, maybe a little bit better than market with a 15% return. The dividend increased it historically pretty substantially. I feel good increasing it with revenue growth to just say, you know what, let's keep that payout pretty small. Majority of that capital allocation is going to share repurchases, a little bit to acquisition reinvestment, and then leaving 10, 15 or so to debt reduction. And we get to a price that needs to fall a little bit more than in half before you get the return I'm looking for here. So, I mean, a lot of the things I'm seeing outside of valuation are very positive signs. But for me, valuation is definitely going to be the most important figure that I'm going to need to be matching with my expectation. And right now, we're just not seeing it. Hope you enjoy the video and have a great rest of your day. Thank you.